Hello there.
Hello everybody and welcome to this week's portfolio update and stock battle. During the week we hit 10 subscribers. You're all wonderful and amazing and thank you so much for subscribing and joining. When we 10 times that number, it's going to go up from a £25 investment per portfolio to 26, which I'm very excited and a little bit terrified about. Our theme this week is cooking, and our portfolios certainly have been. This is Battle 12. I'm the Gentleman Investor. Let's invest. As always, we're going to reveal who won last week's episode. We're going to have a portfolio update, and we're going to battle two stocks against each other. Without further delay, let's get underway. Last week, I wanted to invest in SpaceX. I think it's a fantastic company with an incredible moat, and especially when you consider Starlink, it just prints money for fun. Now, I didn't realize that was such a controversial decision until I saw all the downvotes on Trading 212, which is of course everybody's right, and I appreciate Elon is a very divisive character himself, particularly over the last couple of weeks and things like the US election. However, the name of the game is for me to invest in whichever stock has had the most votes over the last week, and so we're committed, and of our two funds, one certainly came out the winner. More on that in a little bit, and apologies if you don't like Elon, and this week will certainly be less controversial. We're looking at two food-related stocks this week. I certainly love food. I don't think that's too controversial, so I'm looking forward to seeing who wins in these two stocks when we put them against each other. Let's find out how Scottish Mortgage Trust and the rest of the portfolio got on last week. It's £25 per portfolio each week into a pie where you select the stocks, a pie that tracks the market and a pie that generates dividends to pay you. Here's how the three portfolios looked last week. We had added £250 into each. Battle Royale beating the market 6% up versus 3.6%. Let's find out how they got on this week. Here we have the Battle Royale and its performance versus the market over the last 7 days. 1.7% down. The market only 0.2%. Let's have a look at our 11 holdings. Right at the top, Tesla. Didn't do so well last week apparently, minus 0.2. However, the total return is still 47%, very near to 50%. Last week, some green, some red, a little bit mixed. On the whole, our average return is mostly in the red, so our stock's not paying off just yet. Out of interest, I wanted to show you in the analysis, we've now got enough stocks to show our diversification of our portfolio. We've got 38% consumer discretionary, Tesla, On the Beach, Adidas, B&M, consumer staples, we've got nickel, Tesco, telecoms, we've got YouGov, Money Supermarket, we've got some tech now, Microsoft, our financials was the Scottish Mortgage Trust Fund, and we've got some real estate too with Soho REIT. The benchmark didn't have a great 7 days either, minus 0.5%, and the income generator up 0.1%, so all very close and quite flat last week. The dividends from the income generator now up to £8.45. That's up from last week, which was £7.70, so ticking over quite quickly. The next payment is £1.63. and £1.48, after which we will pay someone out, so a total of £3.11. That is up from £2.84 last week, so it is going quickly. And this is how they performed this week. The Battle Royale beating the benchmark once again. It's increased slightly more than the benchmark has, 6.61 going up to 6.89, whereas the benchmark went from 3.62 to down to 3.41%. Now that doesn't necessarily match what Simply Wall Street was telling us earlier about the benchmark underperforming the market. I think that might have been because I added Scottish Mortgage Trust late on Friday and it's calculated its success or failure for the whole week. So we're going to try next week, perhaps add in those stocks on the Monday and only talking about them the following week. Let me know if you agree with that prognosis or if you can figure out any other reason for the discrepancy. But where it counts, Trading 212, that's where the money is. And that says the Battle Royale has beaten the benchmark once again.
3, 2, 1, fight.
This week's theme is cooking stocks. It's between a bakery and a company that produces ingredients for cooking yummy things. Let's see who wins. First up, we have Tate&Lyle, not to be confused with Lyle & Scott, like I got, which is a clothing company. No, this Tate&Lyle is an ingredient solutions provider. Basically, they take sugars and unhealthy things and add them with natural replacements that are slightly more healthier. Somehow they change the substance and texture of foods so that they still taste as good as those with unhealthy things in them. As you can see, they can do this for beverages, dairy, soups, and bakery and snacks. Maybe not so sexy, but this could definitely be a winner. I'm excited to look at the stats behind it. Its competitor is going to be difficult to beat from a sexiness perspective. We all know Biscoff. It makes these lovely little biscuits that go with our coffees and teas. They're also branching out. They've joined with the guys behind Oreo, and they're going to add this flavor, this Biscoff ingredient, into additional things like spreads and syrups and things like that. So many different ways to experience it, not just these biscuits. So they're moving and doing good things as well. Looking at the figures behind these two companies, according to Simply Wall Street, Tate&Lyle has got a lovely, healthy balance sheet. It pays a small dividend, and apparently they've got 3 out of 6 towards the future, but they're also quite a good value proposition. Compare that to Lotus, apparently not such good value, doesn't pay a dividend, however has a massively healthy financials, and equally can be said for the past. Its future also sitting at a 3 out of 6, so nothing to sniff at there. If we compare the two directly, Lotus has its earnings forecast to grow at 12.38% versus Tate&Lyle that's sitting at 17%. Apparently, according to Simply Wall Street, Tate&Lyle also has a 58% below fair value. So that looks like a cheap one at the moment. Let's take a look at and compare their high-level metrics. These are both big companies with market caps in the billions. The EPS for Lotus is crazy at 159, but so is the PE ratio at 65. That is phenomenal. That shows what the market is pricing this growth in for. Dividend yield 0.5% versus Tate&Lyle's 2.5%. It looks pretty clear to me, based on these, which ones I would suggest we vote for. But do you subscribe to the massive amounts of growth that is forecast for Lotus? And if so, maybe that's not a bad investment. I can't wait for you to tell me if you agree that Tate&Lyle is the better option, or perhaps there's another yummy stock that I haven't even thought of. If so, please let me know in the comments. So, who should we invest in? I think it's gotta be... So there we have it. What do you think? Do you agree with that assessment? Would you recommend any other yummy stocks? Thank you so much for watching. I really appreciate you being here. I look forward to seeing you next week.
Goodbye.